Hello everyone, I'm Sandy Franks. This is Taipan Financial News, the first internet-based financial news show. Well, we've got a winner, folks. This week the Dow set a record. After 6 long years, the Dow finally broke through its January 2000 high. Now, I don't know if you're jumping up and down on your sofa like Tom Cruise did on Oprah Winfrey's show, but I bet many investors were filled with joy when the Dow soared 123 points to close at 11,850. But let's not forget to mention the broader market indicators, which also rose. The S&P 500 rallied to its best level in more than 5.5 years, and the NASDAQ composite rose to its best level since May. Oil prices are down from their $78 a barrel back in July. With this much good news, you have to wonder if we've reached the starting point of a new bull market. Well, keep your computer monitor on. In today's program, we're going to answer that question. Andrew Mickey, editor of Breakaway Investor, joins me with his take on the big market and shares his views on where the price of oil is headed. Andrew, thanks for coming on the show today.
Thanks for having me again, Sandy.
Andrew, oil is down, but is this temporary? Should we anticipate prices going back up?
It's not temporary at all, Sandy. Oil's going back down to $30. It's just that simple. The leading causes are production and exploration spending. P&E spending has gone through the roof recently. And recently companies are announced that they'll be expanding their production spending. Recently, Rally Oil upped its P&E estimates for 2007. Mexican state-owned oil company Pemex announced that they're going to be seeking a 30% increase in 2007 for P&E spending. And Exxon will be spending $20 billion each year from 2007 through 2010 just on getting more oil out of the ground. And that's what's going to drive oil prices back down to $30 within the next 3 or 4 years.
Now, Andy, you realize some people will call you crazy for making this prediction. Let's go over the facts again. Tell me why you're so certain that we're going to see $30 oil prices.
Well, Sandy, I've already been called crazy a few times. But another big reason is that we've already been through this sky-high oil price and then sudden drop. In 1980, inflation-adjusted oil prices hit as high as $100 in December of 1979. Then over the next 4 or 5 years, due to increased production and exploration spending, oil fell back down to inflation-adjusted 60, 50, and then continued on down back to the $30 to $40 range over the next 7 to 8 years. And we didn't see another spike in oil prices until Gulf War I.
So you're looking back at some of the historical things that have occurred, and that's what makes you so certain that we're going to get to this $30 oil price.
Yes, Sandy, history repeats itself time and time again throughout the markets.
Well, now, a recent Market Watch article suggests that the rise in the Dow is due to the drop in the energy prices and interest rates. If you see oil at $30, what does that mean for the Dow?
Well, the Dow's kind of a different sort of animal. It's made up of only 30 stocks, and its recent highs were a result of it moving up 600 points since July 3 months ago. And the interesting thing to note, 3 stocks within the Dow have accounted for more than half that move. And they're all facing very specific circumstances, like McDonald's is spinning off Chipotle, Merck is coming out of the Vioxx trials, and Boeing is benefiting from all the troubles at Airbus. And those 3 stocks alone have accounted for 250 points of the 600-point rise in the Dow. So the Dow Industrials is a little skewed due to those 3 events carrying higher.
Okay, so you're suggesting those 3 companies then are what's causing that spike?
Well, those 3 companies are 10% of the entire Dow components.
It's a big portion.
Are accounting for almost half of the run-up. I look more towards the transportation index to see where the markets are actually headed.
Now, I want to go back to this oil for a moment because I'm intrigued by your prediction of $30 a barrel. You know, people like Exxon have fared well in this market. Don't you think that the big oil companies are expecting higher prices in oil?
Well, Sandy, a couple months ago, I actually sat down with a bunch of oil company executives in New York, and every one of them told me they're banking on $30 to $40 oil.
Really?
They will not invest in new wells, new equipment, new anything until based on $60 oil. They don't want to get caught short like they did back in the 80s. They learned their lesson, and I want investors to do that, learn from their mistakes this time.
So they then are pulling back, and that's what you're suggesting is happening now?
Yes, they're making measured investments in increasing oil capacity, and that's going to prevent them from having an oil glut. It comes down to what I always like to say, $10 oil put us in this situation, and $60 oil is going to bring us out.
Well, let's talk about demand for just a minute, because that factors into the price. Do you see demand surging?
Well, with the U.S. economy starting to slow down, interest rates rising, and that's going to slow down the economy and slow down the demand for oil. And in the U.S., where the economy is slowing the fastest, that's causing the greatest oil user to slow down. Because keep in mind, the U.S. uses almost twice as much as Japan and China put together.
Okay, so let me ask you this very important question. What do you suggest investors do? How do they play oil for maximum profits?
Okay, the best way to play oil right now is the oil service sector. Specifically, my favorite company is Acergy. This company actually connects the platforms to the seabed surface wells in offshore drilling. And the things they have going for them is they have expanding operating margins, which proves they're expanding market share without losing any of their pricing power. And they have an order backlog of 18 months. And plus, they're already planning with big oil companies out to 2011 and 2012 for oil projects.
Sounds like a smart play to me, Andy. Thanks.
Thank you.